Unleashing the bears, debunking market crash predictions. While the bull market has been roaring for quite some time, it's important to consider alternative viewpoints. So, let's dive into the bearish case and evaluate the arguments put forth by those who predict a market crash. Segment 1. The warning signs. 1. The bears often point to certain warning signs in the market that suggest trouble ahead. 2. They highlight indicators such as high market valuations, rising debt levels, and geopolitical tensions as potential catalysts for a crash. Segment 2. Historical precedents. 1. The bears often cite historical market crashes, such as the dot-com bubble in the early 2000s and the financial crisis of 2008, as evidence that markets can experience significant declines. 2. They argue that history could repeat itself, leading to another devastating crash. 3. However, it's important to consider the differences in market dynamics and regulatory measures that have been put in place since those events. Segment 3. Economic indicators. 1. The bears closely monitor economic indicators, such as GDP growth, employment figures, and inflation rates, to support their case for an impending crash. 2. They argue that signs of economic weakness or instability could trigger a market downturn. Segment 4. Investor sentiment. 1. Another aspect the bears focus on is investor sentiment. 2. They argue that the market is driven by irrational exuberance, with investors ignoring potential risks and valuing stocks beyond their fundamentals. 3. They believe that once sentiment shifts, panic selling could trigger a market crash. Segment 5. The Contrarian View. 1. While the bears present compelling arguments, it's essential to consider the contrarian view. 2. Bulls argue that the market is driven by innovation, economic growth, and the adaptability of businesses. 3. They believe that the market has the potential to weather storms and continue its upward trajectory. Segment 6. Navigating volatility. 1. Whether you lean bullish or bearish, it's crucial to understand how to navigate market volatility. 2. Diversification, risk management, and a long-term perspective are key elements in successfully navigating market fluctuations. 3. By focusing on a well-rounded investment strategy, investors can mitigate risks and stay prepared for potential market downturns. Segment 7. The importance of research. 1. Ultimately, understanding both bullish and bearish perspectives is essential for making informed investment decisions. 2. Conducting thorough research, analyzing market data, and staying informed about economic trends can help investors navigate the complexities of the market. Segment 8. Evaluating market fundamentals. 1. One of the key factors in determining the likelihood of a market crash is the evaluation of market fundamentals. 2. Bears argue that factors such as high price-to-earnings ratios, excessive corporate debt, and weak earnings growth indicate an overvalued market. Segment 9. Potential triggers for a crash. 1. Bears often highlight specific events or triggers that they believe could spark a market crash, such as a sudden spike in inflation, a geopolitical crisis, or a major economic downturn. 2. While these events can certainly impact the market, bulls argue that the resilience and adaptability of the economy can mitigate their effects. Segment 10. Behavioral biases and the herd mentality. 1. Behavioral biases and the herd mentality play a significant role in market dynamics. 2. Bears argue that investors tend to exhibit irrational behavior during bull markets, fueling asset bubbles that eventually burst. 3. Bulls counter that while herd behavior can lead to short-term volatility, long-term fundamentals ultimately drive market performance. Segment 11. The role of monetary policy. 1. The bears often express concerns about the impact of monetary policy on the market. 2. They argue that a tightening of monetary policy, such as increasing interest rates or reducing stimulus measures, could disrupt the market and lead to a crash. 3. Bulls contend that central banks carefully manage policy changes to ensure a smooth transition and maintain stability. Segment 12. Historical market resilience. 1. Despite past market crashes, the overall trajectory of the stock market has been upward over the long term. 2. Bulls emphasize the market's ability to recover from downturns and deliver substantial returns over time. 3. They argue that staying invested and taking a long-term perspective can help investors weather market turbulence. Segment 13. The importance of diversification. 1. Diversification is a critical risk management strategy that both bears and bulls emphasize. 2. By spreading investments across different asset classes, sectors, and geographies, investors can reduce the impact of any single market crash. 3. Both perspectives agree on the importance of diversification as a tool to mitigate risks and protect investment portfolios. Segment 14. Assessing investor confidence. 1. Investor confidence plays a crucial role in market stability. 2. Bears argue that declining investor confidence can trigger panic selling in a market crash. 3. Bulls contend that strong investor sentiment and belief in the underlying strength of the economy can counterbalance short-term volatility. Segment 15. Evaluating economic indicators. 1. Both bears and bulls closely monitor economic indicators to gauge the health of the economy and predict market trends. 2. Bears focus on indicators like unemployment rates, consumer spending, and GDP growth to support their case for a market crash. 3. Bulls consider the same indicators as evidence of a robust economy that can sustain market growth. Segment 16. Investor psychology and market timing. 1. Investor psychology plays a significant role in market crashes. 2. Bears argue that timing the market is crucial to avoid significant losses, while bulls advocate for a long-term investment approach. 3. Both perspectives acknowledge the difficulty of accurately timing market movements. Segment 17. Lessons from past market crashes. 1. Examining past market crashes provides valuable insights for investors. 2. Bulls and bears alike analyze previous crashes to identify warning signs and better understand the dynamics of market downturns. 3. By learning from history, investors can make informed decisions and be better prepared for future market challenges. Final thoughts and conclusion. 1. While the bears present valid concerns, it's important to maintain a balanced perspective when evaluating market crash predictions. 2. The market is influenced by a multitude of factors, and accurately predicting its future is a challenging task. 3. By considering various viewpoints, conducting thorough research, and staying disciplined in our investment strategies, we can better position ourselves for long-term success in the dynamic world of finance.